Hi, good afternoon, everyone. I'm Darren from Investing Note. Thank you for joining us in these last sessions. Okay, the topic for these sessions is how to exactly live off dividend in retirement. And today we have Willie as our speaker for these sessions. So let me do a very quick introduction. Willie is a CFA in the foundation of the Dividend Titan and a financial research publication for investors growing their wealth safely for retirement, a former research analyst for top private bank, and Willie also run his own consulting firm. Okay, Willie has a deep passion for helping everyday investors take control of their financial future. Okay, so during the presentation, if you have any questions, please type it into the question box, which is on your right hand side orange box. Okay, we will have the time for the Q&A sections. Okay, without further ado, let's welcome Willie. Hello, Willie, are you there?
Yes, thank you.
Yes, okay, sure. So I will pass the time to you.
Okay, thank you.
Yes, great. Thank you.
A very good afternoon. Hello again. My name is Willie, and I run Dividend Titan, a financial publication website. Before we go deep into the trenches on how to exactly live off dividends in retirement and make tons of money in the stock market, I just like to share a bit more about myself, right? But before we continue, the standard disclaimer which I like to share that this is all purely for information and education. Okay, so for me, I'm a founder of Dividend Titan. You can click through the link here to find out more. For us, we are a financial publisher and we help DIY investors grow their wealth safely and profitably every day. All right, so for me, I have been speaking in conferences, seminars. I've been on the center stage. I've ever speak on a cruise before, over the past few years. So this is something which I have deep passion about in investing. So going on, what I'm going to share with you is really the first class ticket to your rich life. The thing is, of all the investment ideas, I've tried over the years, right? Be it your special situations, turnarounds, small cap investing, I find that this strategy stands out above the rest. And really the reason is because it allows me to consistently produce huge returns. It allows me to accumulate more than enough to live a rich life. And what's more important, it makes you financially secure and allow you to earn income safely, and most importantly, feel more carefree about yourself. All right. So for me, if you want to get started investing, today I want to show you this exact strategy which I'm personally using to protect and grow my own money, and how you can, of course, prepare this yourself. So the thing about investing, really, it's a lot like planting a seed in the ground, right? You have to plant your first seed, and once you give it some fresh sunlight, water, and air, the seed starts to automatically take root and grow. And you don't have to do anything more about it. So that's the beauty of this strategy. You carry on, with your normal day and let the force of nature do its work, right? And over time, it's going to turn into a plant, then a tree, then it will start to bear fruits and flowers. So it's going to give you, shade for your family, food for your children, and it's going to grow more and more. And really, that's what this investment strategy is all about. So you don't really have to have a degree in business or work in the financial industry like myself. You don't have to have any clue, with regards to what is debt to EBITDA or discounted cash flow, what is cost of capital. You don't have to worry. You don't need all that. Because the thing about this, what I'm about to tell you, this little secret, which few people actually use these days, but really it's an open secret, because most people overlook this strategy. It's that it actually works, right? And what truly matters to growing your wealth today, which I want to share, is really to collect a basket of solid, elite dividend growers at a fair price, right? So anyone can actually use this strategy. You know, I found this on the internet a couple of years ago, and it really hit me. So you can see on this news here on CNBC, a janitor secretly amassed an $8 million fortune and left most of it to his library and hospital. So this guy, a very, very ordinary person who knows nothing about, finance or financial numbers. I quote from the article, he only invested in what he knew and what paid dividends. So that was very important to him. So you can actually get this article, by just Googling the headline. And this quote was actually written by a close friend of Mr. Ronald Read. So he is actually a janitor for most of his life. He passed away a few years ago at the age of 92. And he really amassed this fortune or this wealth through this dividend growth strategy, right? And, after that, he left this huge amount, he donated to the nearby hospital and library. So what really I want to say is, anyone can get this strategy working, and the thing is, when we look at dividend growers, these are basically the kind of performance which you would get to see. It's not just in the US market, even in our very own home ground in Singapore, you will be able to execute this strategy easily, right? You must be wondering, like, hey, how come I'm seeing DBS, ST Engineering, SETS giving like 11%, 6.5%, even 13% dividend yield? And on top of that, you still have that kind of massive share price gains. Well, you might be thinking, hey, really, are you trying to joke around with me? Right, like right now, DBS, is only about 4 to 5% dividend yield. ST Engineering is about 3 to 4%. Where do you get all these huge numbers from? Well, you don't get too worked up too much. So the whole idea about dividend growth strategy is this, right? What you truly want to do at the end of the day is you want to grow your yield and not chase it. You see, the myth about dividend investing is people tend to look at the highest yield and they just want to buy stocks at the highest yield, which is wrong, because you might find yourself buying companies which are already not doing well. That's why they have a huge dividend yield. So over time, the stock market, they will eventually find out that some of these companies can't pay these dividends, and eventually the dividends will get cut. So what you want is to be picking out strong companies, fundamentally solid companies, and then grow the yield from there, right? What do I mean by this? So let's take a very simple example. So let's say if you buy a share at $50, okay, and it pays you a $2 dividends per share today. So that means your dividend yield today is about 4%, right? So simply you take $2, divide by $50, you get a 4% dividend yield, which is pretty average, when you look at most of the Singapore stocks today. Sometimes it's even lesser, right? And the ones which are usually yielding much higher than 4, 5%, potentially they are already in trouble. That's why they are really yielding so high, correct? Then what you want to do is, you want to invest in these companies and wait for that dividend to compound itself. So that's where the magic really begins. So let's say, if you buy this share at $50, at year zero, if you buy today at $2 per share, if you look at it, if these dividends which they pay you grow 10% every single year, right, from $2 to $2.20 to $2.40, and so on and so forth, at the end of the 10th year, what you're going to get is a dividends paid to you at $5, right? It might not seem a lot, but if you think about it, $5, if you divide it over your initial investment of $50, you're going to get that 10% yield, right? So that's how you want to invest in companies which are able to grow your dividends safely, not buying into high yielding companies and then praying that the share price, will go up, and praying that the dividends will actually go up, right? You don't want that. What you want is to start growing the yield right now, right, before it's too late. So at the 10th year, you'll realize that this particular share, this example, the share would have not only grown in capital gains, but of course, more importantly, is the yield which will actually grow. So you can see over time, as the dividends increase, the yield will increase. So at the end of the 15th year, this yield will grow to 16%, right? If we assume that these dividends continue to grow at 10% every single year, then at the 20th year, that yield will become 27%, right? Then you must be asking me, hey, really, are there really such such stocks like this in the market? Because I've not seen this kind of double-digit use before, right? And the quick answer is yes. Some of these stocks, they're not very it might not be very easy to find in today's market, but I can tell you that they exist, right? You just have to look slightly careful, right? And these are some of the stocks or the businesses where we tend to typically buy their products and their services. One good example is this. After this webinar, let's say if you go down to NTUC or your supermarket to grab your groceries, I'm pretty sure you would have come across some of these products which you are seeing in front of you right now, right? Clean and Clear facial foam, Listerine, Tylenol, Johnson's baby powder, and your women's hygiene products. So these are all very common products which we buy. And even during the COVID last year, all of us are just grabbing some of this daily essential stuff. You can see how popular, how powerful this business is. And it's a very simple business, right? It sells consumer products to people like us every single day. So we always need these products. It's not something where you buy once and then you forget about it. And this company is none other than Johnson & Johnson. You see, not many people know about this company, but all of us, I'm pretty sure we know the products it's selling. And this company has existed for the past, hundreds of years ago. In fact, it's over 140 years ago. And it's founded by Robert Wood Johnson. And today its market cap is close to $400 billion. In fact, I think the latest market capitalization it has already gone above $400 billion. And it's way larger than our sovereign wealth fund, Temasek Holdings. Now, if you look at Johnson & Johnson, how you want to identify some of these strong elite dividend growers is this. You want to pay attention to its gross profit margins. You see, Johnson & Johnson has a very, very strong branding, right? It sells products which we know and which we buy. So naturally, it commands a very high gross profit margin of at least 65% on my chart. So on average, you can see over the past 10 years, its gross profit margin is more than 70%. So gross profit margin is very, very simple. It means that you basically take the sales or the revenue of the business minus off whatever the cost it takes to produce. So for a company like Johnson & Johnson, all it needs is to put in a certain amount of money to create those products, to manufacture these products, and then it can mark up at a very, very high premium and sell it to people like us. And the reason why it can do that is because it has a very, very strong branding. So how we identify companies with strong branding, for example, is to look at the gross profit margin. So that's the first thing which you want to look at. Now, the next thing which you want to look at to identify these dividend growers is you want to look at is free cash flow. So you want a company like Johnson & Johnson to be able to generate that massive free cash flow for you. How do you actually look at this? Very simple. You can actually look at the past, 8 to 10 years of data, and you can just look at the operating cash flow minus off the capex. So the capex is basically the bars in red, and basically the capex is the amount of money which Johnson & Johnson has to put in every single year to run the business, right? In order to keep the business going. And if you can see, right, every single year for the past years, it's blue color bar, which is the cash it generates from its operations, meaning that the money it makes, after you minus off the red color bars, it's positive because you can see the blue bars tend to be much higher than the red ones. And you can see every year it's generating a positive free cash flow, right? You can see every single year here. Now, for a company like Johnson & Johnson, once you put in money every single year to maintain the business, to grow the business, to expand the business, to put in money to conduct research and development, to do its marketing and distribution, after doing all those, the money which is left behind, which is the free cash flow, what do you think it's going to do with the money, right? Of course, it's definitely going to reward their shareholders or its shareholders. And you can see Johnson & Johnson is truly one of the best dividend growers around. Since 2010, it has paid to shareholders $2.11 per share, and it has been gradually increasing its dividends year after year. So at the end of 2020, it paid out close to $4 per share. in dividends. And when I last checked its financial statements last year, it continued to increase or maintain its dividends during COVID. So these are the kind of companies or stocks which you want to be looking at, where crisis or not, people still buy its products. The company still pays out its dividends from its strong free cash flow. And you don't really have to worry this stock going bust, this stock facing huge capital losses, because when you are looking at such numbers like this, in terms of the dividend growth, the strong free cash flow, the high profit margins, what you're going to get is a growing dividend yield and a rising share price. So this is really what you want to see, right? And you can see from the chart, right? If you had bought Johnson & Johnson since 2000, and if you have held it all the way till now or all the way till today, your dividend yield on cost would eventually grow to 10%. So imagine this, right? If you are in your late 30s, early 40s, planning to build your portfolio for retirement, right, over the next 10, 15 years, and you start picking all these shares up, today, and if you hold it on over the long term, what you're going to see is that your portfolio will start to grow. Like the example which I give, right? Everything starts from that first seed, and you start to grow it, and you let this strong, unbreakable force of nature do its work, right? When you're picking strong companies like this, you don't really have to worry too much about the business, about the stocks, because the products which it sells takes care of the business. Right, so you have bought $38 per share. Today, it's roughly about $150 or $160 per share. Right, so this is really how you want to grow your dividend, your dividend yield. Right. So the 3 points which I spoke about, if you want to identify some of these solid elite dividend growers, is number one, you want to have a high profit margin. Right, you want to have that massive free cash flow. You also want the stock to be growing dividends year after year, right? So these are the kind of companies which you want to be looking at, right? And these are the companies you want to pick to safely build your wealth. So you might be thinking, hey, really, hold on. If I'm looking at businesses like Johnson & Johnson with huge competitive advantage, then why don't I just pick the huge growth stocks today, that invest all their earnings every single year to get an even bigger return on investment? Like everyone's talking about the technology stocks of today. Of course you can, right? If you're looking at dividend growers, perhaps you might be missing out on some of these technology stocks which we are seeing. But here's the thing, right? If you are investing for retirement, and if you have only one shot, or all of us have only one shot at retirement, we don't want to be, making one huge mistake, buying the wrong technology stock, and then, facing a huge loss on it. We all know that how technology stocks, while it can go up a lot, but it can also lose people a lot of money, right? Think about the tech bubble in the late 90s to the early 2000s. And for every winner like Facebook, like Amazon, there are more than 10,000 failed companies, tech companies, right? And I'm talking about listed companies. So trying to find the next Facebook might cause you to lose more money over the long run, right? So in the short run, yes, sure, you might be making a lot of money, seeing how the technology stocks have rallied, but it's highly unlikely you'll be able to consistently spot some of these companies, right? And if these companies don't turn profitable eventually, you could get wiped out on a single stock. So at the end of the day, the market is smart. If it knows that the company would turn profitable, the share price will continue to go up. But if the market knows that this company would never make a profit, then you start to see some of these shares start to fall, right? So these companies, they tend to be very vulnerable as well. And there are no sustainable business. It's very difficult to actually have many sustainable businesses models in tech companies like this. So if you think about it, if you look at companies like your BlackBerry, Nokia, Motorola, or even GoPro, you'll see that some of these well-known tech names, they actually fell from the top of the world to the ground flat, right? So this is really what the difference when you are investing in solid elite dividend growers here, right? Now, this is something which is this is not something which I sort of come up or which I just plucked it out from thin air. Like even famous investor Warren Buffett, a multi-billionaire today, he uses this widely known secret, and he started this strategy, years back. The reason why people don't talk about him using a dividend strategy is because Warren Buffett actually made use of this strategy much early on in his early years when he was building the foundations of his company, Berkshire Hathaway. And as it grows, as the company grows, as the money gets too huge, it's hard to find profitable investments. So he needs to find stable companies, which would stabilize the profits for Berkshire Hathaway, right? And also to be able to grow his business safely as well, right? That's why you don't see Warren Buffett buying a lot of technology companies. If any, he buys very simple to understand businesses. And one such example is Coca-Cola, right? We all know that Coca-Cola is really popular. During Chinese New Year, you have no idea what to buy, just buy Coca-Cola because it's safe, right? Everyone drinks Coca-Cola. And that's also because it's a very sweet drink. So Warren Buffett bought Coca-Cola at $3.25 per share in 1988. So he has held on to these shares, for slightly more than 30 years already. And today, based on the share price which he has held on, which he has bought in 1988 at $3.25, his dividend yield on cost is actually 49% today. How do I get this 49%? You see, today Coca-Cola pays a dividend of $1.60 per share. So after stock splits, and so on, this $1.60 divided by his initial capital, which is $3.25 on each share, that would give you close to 50%, right? And that is really how you grow. So the longer you hold these businesses, these strong businesses, the yield gets higher. So he has held Coca-Cola, for almost or more than 30 years already. Even if he had held Coca-Cola at the 15-year mark, his yield would have, easily hit double digit, right? And that's the thing, right? People are not patient enough to see these numbers grow themselves, right? And really, this is really the foundation on how you can exactly build a dividend portfolio or dividend growth portfolio for your retirement, right? So just a quick recap on how to exactly live off dividends in retirement. Number one, you will want to collect a basket of solid elite dividend growers, number one. You also want to grow your yield and don't chase it, right? And with that, I will end off my presentation early so that I can take some questions and answers. If you want to find out more about this particular strategy, you can always go to my website at dividendtitan.com and you can get all the free guides which I share with you guys, right? So I'll head on to answering some of the questions. Let's see. Okay. First question, would you advise us to search dividend stocks in US market if we take into consideration the withholding tax? This is a very good question, and I get these questions a lot from my readers. The answer is yes, I will still continue to search dividend stocks in the US market. And really the reason why is because if you are only focusing your dividend stocks in Singapore, let's say, assuming all of us only buy dividend stocks in Singapore, you're not really going to get anywhere with the share price appreciation today, because when you're buying dividend stocks, or if you want to have a dividend strategy, you don't want to just focus on the dividends alone. You want to focus on the capital appreciation as well. So you want to focus on the total return of the entire portfolio. And if you can see, earlier on from my example, right, you can see how some of these US companies like Johnson & Johnson, 3M. So if you know 3M, the Post-it notes, and Hershey's chocolate, very common products, very common products in a huge business. These guys, they have huge gain, much higher than our Singapore stocks, right? You can see ST Engineering, SATS, DBS, they have very good gains, but the gains are not as phenomenal as the US company. So while you might, get that 30% withholding tax, but at the end of the day, as your dividend yield grows, even after tax, you will still have, close to a high single digit of dividend yield. Plus, you get to enjoy a much higher capital appreciation. So you get a balance of both worlds. And really, that's what you want when you want to build your portfolio, not where you buy into, a Singapore stock, and then while you're collecting dividends, the entire portfolio keeps losing money from your capital losses, right? Okay, let's see. Next question. I guess only a very small percentage of companies have steadily growing dividends. Am I right? Many strong companies ain't the same like J&J. Yes, that's very, very true. That's why I've mentioned doing this strategy, there might not be a lot of companies out there. There might not be a lot of stocks out there for you to pick off, but I would say that it's not hard to find them. We just need to open our eyes, pay more careful attention to some of these companies, because at the end of the day, you don't have to buy all the stocks in the world. You just need a very good diversified portfolio to run, your retirement portfolio, right? And really, some of these examples which I gave you, these are really not hard to find if we, go out, do our shopping, we listen to our wife sometimes, on what she buys, then we can get a better idea on some of these stocks, right? Okay, based on the current share price of JM4160, with a dividend yield of $4, and this is before. Okay, so all right. Okay, what sector gives good dividends for SGX? So Singapore stocks. Right now, to be honest, there aren't many. So you only have your banks and your REITs. And you can't possibly hold your entire portfolio with just banks and REITs. I mean, if you think about it, you can see how last year a lot of the REITs and banks have came off, right? And if we are not careful, we might have sold them at a loss. We might feel very uncomfortable with some of these holding on to these stocks. Imagine your entire portfolio is just down. And it's the same, during the days of our global financial crisis, the same thing happened where REITs and banks also went into trouble. So that's the thing which you do not want, right? You do not want to just focus on just one or two sectors. You want to diversify out. And in Singapore, sadly to say, it's either REITs or banks or properties. It used to be oil and gas as well, but after the oil price crashed, there isn't really any quality oil and gas companies anymore. That's why we have to look out. It's not just the US. Look even into Hong Kong, right? Okay. Do you have any short to mid-term strategy in investing dividend stocks? Yeah, of course. I mean, at the end of the day, the one which I'm sharing with you, you have to apply that as well. When I say short to mid-term, at the end of the day, 1 to 5 years, I would still use this strategy because, frankly, there isn't really a workable short to mid-term strategy, as of now, because these are what we call trading or tactical trading, but I'm not exactly an expert in it. What I see is really the long-term fundamentals, because it gets very tiring after a while to be monitoring the market every single day. You could do it now if you are young, in your 20s, in your 30s, in your 40s. But as we all age, we want to spend more time with our family, with our friends, with ourselves. You don't want to be monitoring the market every single day. That's why this strategy, comes across as, much, much more effective. Are we reinvesting our dividend? Yes. So the dividends you collect, the reason why this strategy is so powerful is because when you reinvest, when you get these dividends, you not only enjoy the capital gains, but you can reinvest these dividends as well. And if you don't wish to reinvest these dividends, you can always take it out, and you can spend it. So that's the power, the flexibility of having this strategy. Your slide on dividend yield on those selected stocks is based on what time period? So these are all based 10 to 15 years ago, right? So I'm looking at things long term, right? You are not going to get yields which are based on of last year or 2-3 years ago, right? You can see like Johnson & Johnson, it hit 300% at 11% yield. I showed you the example here, right? So this chart was since 2000. So if you had bought this in early 2000, that's how you can actually grow that kind of view. So it's really all about being patient, all about being disciplined, right? If you are, in it for short-term gains or tactical trading, then I'm sorry, this strategy isn't really working out for you, right? What is the investment strategy live off dividends in retirement? All right. So this is like what I've mentioned, having a dividend growth strategy. So basically what you want is to collect a basket of solid elite dividend growers, and you want to be growing the yield, right? You want to be growing the yield. But here you want to be growing the yield and not chase it. Okay. Let's see. Okay, comparing high dividend yield versus high dividend per share, which would you recommend? I would recommend both, have a combination of both, but I will focus more on growing the yield itself. Because you see, unlike in the early 1970s or 80s, where information is still not very transparent, today, information, is everywhere. When a company has a very high dividend yield, it means something is wrong. It's not like last time when there's a very high dividend yield stock, in the 80s, people wouldn't know about this because people don't have the internet. So you can actually arbitrage based on looking deeply into the numbers. But these days, the price information is so transparent. The moment the market sees a stock trading at a high dividend yield, definitely something must be wrong, because everyone knows, or we assume that the market knows what's going on with this company, right? The internet allows us to be very transparent to information. So when you are only focusing on high dividend yield companies, chances are it might be a value trap. So we have to be careful. But of course, it doesn't mean that all these companies are bad, right? So we have to be careful. And that's why we need to have a combination of both.
Great. Thank you, Willie, for sharing with us and answer all these questions. So remember to click on the virtual hall. We have a surprise for you. The virtual hall button is just on the top of the website. Okay, thank you for being with us on this 4 days program. And remember to rewatch all these great sharings. Okay, once again, I would like to thank Willie for sharing, for your great sharing, and thank you to all the audience, and thank you again for joining Invest 360. Thank you very much. See you next time.